All right, good evening, ladies and gentlemen. This is June Collier, your instructor tonight. This is Stock Investing for Complete Beginners. The date is November 13th, 2023. We are now inside of week number 3. I'm excited about week number 3 because we're now getting ready to learn how to pick stocks. A lot of times people ask me the question, how do you know what stock to pick? And what should I be looking for in a stock? So tonight we're going to talk about the subject called fundamental analysis, and we're going to stay in fundamental analysis for at least another week, maybe 3 weeks. There's a lot that's compacted inside of fundamental analysis, and I want to take my time as we go through this because there's a lot here, and I don't want you to get lost. So I've broken it up so that you can get bite-sized chunks and bite-sized pieces to learn how to look at a company fundamentally and make sure that it's strong. Okay, so let's go ahead and share our screen. Sorry to hear about that, Boss Love, but I pray that all is well. All right, let's go ahead and get started here. Jump over to our training here for tonight. Fundamental analysis. This is where we're going to start looking at the financial data of a company. We're going to actually look at some companies here tonight. And we'll do a comparison. I got 2 companies I'm going to look at tonight. We'll do a comparison of both companies. But this is where you begin to look at the company to determine if this is a company you want to invest in. So before we actually get into this, here's what I want you to understand. And I'm going to try to paint the picture tonight so that we make it very easy for you to understand. A company is just like a person. So as we begin to go through the fundamental analysis of these companies, I want you to not get so overwhelmed in that they're a company. I want you to think of them as an individual. And I'm going to give you some comparisons as an individual and company. And would you want to invest in that individual? Okay, so let's jump straight in. The goal of our training is to teach you how to evaluate a company based on the company's financial statements. Now, I don't want that to scare you away. I'm going to break it down, and we're going to walk through this over the next 2, maybe 3 weeks, so that you know how to really look at a company. So don't get scared, because I'm going to take it easy. All right. So the first question that you may have is, what is fundamental analysis? You may have never heard of that term before, but fundamental analysis is really looking at the financial data of a company to determine its intrinsic value. Now, the word intrinsic value simply means, what is it worth? What's the worth of the company? So if the company is worth $100 a share and is selling at $90 a share, you know that it's now time to buy that company because people haven't realized its true value. 6 weeks ago, Microsoft was trading at $311. And I started screaming to everybody, right? Get you some Microsoft, get you some Microsoft, because I understand and understood the intrinsic value of Microsoft. It was 311 when I said get some. It went down as far as 309. And then it turned around, and today is sitting at at least on Friday was sitting at 369. So, I mean, that's almost 20% in 6 weeks that Microsoft grew. Because I understood the value of the company, I know when the company is on sale, when the stock is on sale. So we know when a pair of shoes are on sale. We know when a pair of jeans are on sale because we kind of keep up with that and we kind of know. Well, the same is true in the stock market. If you keep up with certain stocks, you'll know when they actually go on sale, and you'll know this stock is 10% off. This stock is 20% off. I need to get some now. This is a great deal. And so that's what fundamental analysis will actually help you do. So we're going to look at the financial performance of the company, how well the company is doing financially. And I want you to compare the company with the person. So with a person, if I'm comparing a person, I'm going to be looking at how well does that person manage their finances? How much revenue do they have coming in from their job? What does their credit score look like? How much debt do they have? Are they paying their bills on time? These are all the things that make sense if we look at an individual, but you can do the same thing with a company. The growth potential. What potential does this company have as far as growing? The growth potential of an individual. How do we determine an individual has growth potential? They're going back to school to maybe get further education, right? Maybe they're studying XYZ type of subjects. Those are things that we would see in the individual as far as their growth potential. Management team. So the company has a CEO and they have vice presidents and presidents of different departments and divisions. You want to look at their management team. Who is their CEO? Who is the CFO? Who's the CTO? What did they do prior to becoming the CEO there? Right? Those are things that you want to look at, because oftentimes when a company is doing very poorly, they get rid of that CEO and bring somebody new in. For example, UPS. UPS has a fairly new CEO. She's a female, and she came from Home Depot, and she's turning UPS around. That stock is actually turned around and is doing very, very well. And so the management team makes a huge difference. Who's managing that team? The competitive landscape. What's their, you'll hear somebody says, what's their moat? And the moat, if you think about a castle, the moat is that circle of water around the castle that prevents people from getting to the castle so easily. The question in stocks is, what makes their company so strong that others just can't penetrate? What do they have that other competitors can't compete with them on? So we'll talk about the competitive landscape. And then, of course, looking at the valuation of the company, again, knowing what the true value is of the company and seeing that company when it's at a discount. That's what fundamental analysis is all about. And over the next couple of weeks, we're going to be talking about how to determine that. Now, why is fundamental analysis so important? Why should we research the fundamentals of a company? Because it's going to help you make an informed decision, and it's going to increase your chances of success. There's a reason why I'm so confident about Microsoft, because I've studied the fundamentals and I know the fundamentals like the back of my hand. They are a strong company. If not, one of the strongest companies in the market today. You're going to see that tonight. I'm going to share that tonight. I'm going to show you what I see when I look at Microsoft. Okay. Now, fundamental analysis will allow you to identify undervalued stock. So 6 weeks ago, when I was screaming, hey, get some Microsoft, it was because I know the fundamentals. And I saw Microsoft was undervalued for a quick period of time. The window was a short period of time. That window was open maybe 3 or 4 days. And it was gone, right? When that window closed, it closed. And not only did it closed fast. So fundamental analysis allows you to identify undervalued stocks. For the most part, you're going to be sitting on the sidelines waiting for your stock to come to you. See, we're not just jumping into the stock market. We're going to sit on the sidelines and wait for that stock to come to you. So you're going to create a watch list and maybe have 5 to 7 stocks on that watch list so that you know each one of those stocks. And when one of those stocks comes down to your number, which means that they're undervalued, that's when you jump in and get that stock. So a lot of people started asking me, June, should I get Microsoft now? And the answer is no. Microsoft's already taken off. It reached its highest all-time high on Friday. All-time high closing price on Friday. You don't chase a stock once it reaches all-time high, okay? Because once it's reaching its all-time high, it has a stronger chance of coming back down than it does continuing to go higher. And sure enough, today, Microsoft was down $1 or $2 today. So we don't chase stocks, but we learn how to find them when they're undervalued. Also, by looking at the fundamental analysis, you'll begin to understand the risk and the rewards of investing in that company. So every company has risk and rewards. There's risk. Even at 311, there was risk in investing in Microsoft. especially if you're investing short term. We're going to be investing long term here, but you need to understand what those risks are. Are you willing to take the risk? And then finally, make informed investment decisions over the long run or the long term. What we're talking about in this course is we're talking about buying stocks, holding those stocks for a period of time to watch the capital appreciation happen with our stocks. I use that word, capital appreciation. You should have learned that in your terminology, okay? That's just going to be the rising price of the stock, okay? All right, so let's jump into this. This is where the road meets the rubber. There are three main financial statements that we're going to look at tonight when we look at companies. And you got to know what each one of these financial statements are all about. Anytime a company goes public, here's the difference between a private company and a publicly traded company. By law, a publicly traded company has to put out their financial statement on a quarterly basis. So they have to disclose their financial statements, open up their books to everyone on a quarterly basis. And those financial statements that we get a chance to look at are going to fall into three financial statements. The first is the balance sheet. Now, the balance sheet reports on the company's assets, liabilities, and owner's equity. Okay? Assets, liabilities, and owner's equity. So we know what assets and liabilities are. Asset is if I'm looking at an individual and I say, what are your assets? They might say, I've got a home, I've got stock, I got a car, I got furniture, I got gold, I got a ring. What are your liabilities? I got a mortgage on the house, I got a loan on my vehicle. Those are your liabilities. And then the owner's equity is how much of their company do they actually own. Because remember, if you're a publicly traded company, now you have other owners in your company. That's your balance sheet. Then the next statement is your income statement. And this is going to report your revenues, your expenses, and your net profit, okay? And so this is almost like, if I had to describe it for an individual, this would be their pay stub. This is their pay stub that kind of reports how much money they make, what's going out to taxes. This is your pay stub. So if we're looking at an individual and we say, what's the individual's income statement? We're going to look at their pay stub. That's just an easy way to kind of think about it. And then finally is your cash flow statement. Now, your cash flow statement is very similar to your income statement, okay? The cash flow statement reports cash entering a company and cash exiting a company. Now, why do I say it's very close to the income statement? Because we're reporting on your revenue that's coming into your company and the amount of money that is going out as expenses. So when you look at income statement and cash flow statement, they can look very, very similar. But let me explain to you the difference right now before we get too deep into it. The difference between an income statement and a cash flow statement. And I'm gonna use an individual as an example. So let's just say that you make $100,000 a year and all of your liabilities, your expenses, and your debt total out to $90,000. That means that you made 100, you've got $90,000 worth of income expenses, you're going to have $10,000 left over, you're okay, right? You're not in the negative, you're not in the red, you're not in the hole. That's your income statement. Your cash flow statement says this. If you're making $100,000 a year, that's roughly around about $8,000 and some change a month, about $8,000 a month. And let's just say that you're paying your bills each and every month out of that $8,000. But in December, you got your insurance that comes up, your 6-month insurance. You got a life insurance policy that you have to pay once a year. You've got some other things. And so your total amount that you have to pay in the month of December is $10,000. But you only got $8,000 coming in. Well, you got negative cash flow in the month of December. even though your income covers your expenses for the entire year, your cash flow in the month of December is off because you got more expenses in the month of December than you have cash flow that's coming in. So hopefully that makes sense. The income is the overall amount of money that's coming into your household, or in this case, the company, and then the minus the expenses that they have. But then cash flow is, do you have enough money to make payroll for this month? Do you have enough money to take care of all of your expenses this month? You see, your employees don't want to hear, well, hey guys, I ain't got it right now, but I promise in January I'm gonna have it. I'm gonna have all the money that you need. I'll pay all of you all your money in January. Your employees don't want to hear that. They want their money in December, right? And so that's called negative cash flow. So sometimes you can earn enough money, but you can have negative cash flow if you're not managing your money properly. All right. I hope that makes sense. But we're going to jump a little bit deeper and we're going to talk about the balance sheet. And then once we finish talking about all of these, we're going to actually go out and we're going to look at these financial statements on Microsoft and another company that I'm going to choose. So here's the balance sheet. On the balance sheet, you're going to have three main areas on your balance sheet. On the left side, you're going to have assets. On the right side, you're going to have your liabilities, and then you're going to have your owner's equity. And what should happen is the left side should match the right side. That's why it's called balance sheet. It should balance itself out, okay? So your assets, this is going to be anything like cash. It's going to be any accounts receivable. It's going to be inventory that you have. It's going to be just all of your assets, okay? Then we've got, and that includes land, the building, even the logo. You know, if you think about Apple or you think about Nike, the logo is an asset, all right? The brand is an asset. So those are all your assets. Then you got your liabilities. Your liabilities is the debt that you owe someone else. Taxes, that will be a liability because you got to pay Uncle Sam, right? Any expenses that you have. Accounts payable. So maybe you've got some stuff that you bought, now it's time to pay. That's going to be a liability. You're going to see salaries as a liability, okay? And so oftentimes what companies will do, and this is just a side note for you, you'll see when companies say Microsoft just laid off 1,500 people, 2,000 people. Google just laid off 3,000 people. XYZ company just laid some people off. What they're doing is they're streamlining their balance sheet, and they're making their balance sheet look sexy. Because see, all of those employees that they just got rid of, they just minimize their liability. And so they're making their balance sheet look good. The easiest and fastest way that you can make your balance sheet look good is by letting some people go. So here's what that means. When you hear in the news that Microsoft just laid off 2,000 people, Google just laid off 3,000 people, if you don't understand stocks and you don't understand the balance sheet, you would think that that's a negative, because the news reports it as this negative thing. Microsoft just laid off 2,000 people. But what June heard was Microsoft just made their balance sheet look better, right? So the next time Microsoft has an earnings announcement, their earnings announcement is going to be a little bit better because they laid 2,000 people off. So you got to start understanding how this works. So when you hear certain news, you know how to correlate that news with what really is happening with the stock. Not saying that it's good that Microsoft laid people off, but as a shareholder, I'm happy because the balance sheet is going to look better. Hopefully that makes sense. And then equity. These are claims made by the company's owners, such as shares of stock, okay? So the owner's equity. This is the equity as we know it is shares of stock, okay? The value. So that's the balance sheet. Now, I want to give an example of a balance sheet and compare it to an individual, because I think it's important, because if you have never taken accounting or anything like this, then these terms may be foreign to you as it relates to balance sheets and cash flow statements and all of that. So we're going to compare it to an individual. So when we look at assets, that's going to be cash, that's going to be inventory, accounts receivables. What's accounts receivables? That's, I sold something and now I'm expecting the payment to come in within, the next 30 to 90 days, right? If you got a small business, you know exactly what I'm talking about. You go out and you service a client, and then they have, anywhere from 30 to 90 days to pay you your invoice. Okay, they got a 90-day invoice to pay. So that's called accounts receivable. So there's money out there that's owed to them that they're going to be waiting to receive. Plant and equipment, intangible assets, that's an asset. For an individual, it's pretty simple. It's how much cash we got in the bank, how much we got in our savings, what do we have in our investments, what about our property, which is our home, land, and maybe some vehicles. Those are going to be the assets in a individual category. Liabilities, accounts payable, debt, deferred taxes. So these are all things that companies have to pay out, okay? Anything like that. For an individual, a liability would be something like credit card debt, student loans, or a mortgage. All right. And then equity, ownership interest of shareholders for a company. For an individual, your equity would pretty much be your net worth. Okay. So my house is worth 500,000. I owe 200,000 on it. My net worth is 300,000 because I got $300,000 worth of equity. All right. So that's a balance sheet. And we have to balance all of that out. That has to be balanced out. Now, let's now talk about an income statement. This is where you find out if the company has made a profit or taken a loss by looking at their income statement. And this is going to be the sales revenue. So every company has to be selling something, right? So they got to sell something, and that's going to bring revenue in. This is money made from sales. And then all of the money that you make from sales isn't profit, because there's a cost of goods that you sold. So let's just say, for example, Tesla sells a $60,000 Tesla. Well, yeah, Tesla makes $60,000, but it cost them $40,000 to make it. So that's the cost of goods sold. So even though they sold the Tesla for 60, they did not net 60. You have to subtract the cost of goods. This is the cost to produce the product, okay? Then you got expenses. What are some of your expenses? Well, if you're selling something, that means you got a salesman. Well, you got to pay your salespeople commission, and then the salespeople don't work by themselves. They usually have some kind of admin person, some support people to help them in the support. So again, those expenses are going to be the expenses of actually just running the business, of having those sales. That's advertising, administration, salaries, etc. Okay. And then you have a net income or loss. So here's what I want you to write down on your piece of paper, because you're going to hear me talk about this. And we're going to talk about it tonight, but I want you to write this down. I'm going to talk about top line revenue growth. I'm going to say that again, top line revenue growth. That's going to be your sales revenue. That's going to be all the money that you brought in. And then I'm going to talk about bottom line revenue growth. And then the bottom line revenue is your net income or loss. And we're going to see an example of net income, and we're going to see an example of net income loss or net loss. The two examples I'm going to show tonight. All right. So you need to know top line revenue, bottom line revenue. Now, here's why that's important. Some companies will make more money year after year in sales, and that's a good thing. That's a good sign. But you can't just look at the top line revenue. So if I make $1 million this year, but then you go down and look at my bottom revenue and I spent $2 million, I'm $1 million in the hole. So that's why it's important to not only just look at your sales revenue or your top line revenue, we also got to look at our bottom line revenue, which is our net income or net loss. You'll see that and it'll make sense when we get there. All right. Now, how does this work for an individual? Well, we got money coming in and money going out. So revenue from sales, interest income. So a lot of times companies might do some financing, in-house financing. So for example, if I'm a small mom and pop car dealership, I'm going to make revenue from selling the car. And then I'm also going to make revenue from financing the car in-house. So that's interest income. Or maybe as a company, I'm invested in the stock market as well. And I'm making returns on my investment. Okay. For an individual, the money coming in is going to be from your employment, income from your employment, investment, and any government benefits that you got coming in. Maybe you're retired, you got a Social Security check or something like that. Outflow is going to be your expenses. So this is your bottom line. This is what takes away from the top line. Salaries, rent, utilities, taxes, all of that takes away. If you compare that to an individual, he got income coming in, but then he's got a mortgage or rent, he's got food, he's got transportation, entertainment. Okay. So that's how we're going to determine their income statement. Money coming in, money going out. Hopefully you got something left over. Everybody get that? It's pretty simple. We all, as an individual, everybody on this call has an income statement. You got money coming into your household and you got money leaving out of your household. The goal is to have more coming in than what goes out. Same thing for a company. All right. All right, let's go on. The last one is our cash flow statement. And you guys know what we talked about. A cash flow is just mapping where every dollar is flowing in the company. All right. And so what are our operating activities? These are revenues from sales and our operating expenses. What are we investing? Because companies buy and invest in stocks too, right? You're not the only person that's investing in stocks. You know, you might have Google and Google might invest in Microsoft. So Google might own, 1 million shares of Microsoft. Even though you kind of think that they're competitors, they still are investing, okay? The purchase and sale of investment. So you'll see that on a cash flow statement, you'll see that they invested. Financing activities, okay? So they may raise cash through debt or issuing new stock. So what is raising cash through debt? Anybody know what that term is? We already covered it. If a company raises cash through debt, what is that called? I'm gonna stop here and just kind of look in the chat and see if anybody remembers, what do you call when you're getting money from a loan? When a company gets a loan, what is that called? A bond. Thank you. Thank you, thank you, thank you. A bond. So when we talk about raising cash through debt, that is a bond. The companies are floating a bond. And all companies borrow money, all of them. They all borrow money, they all issue out bonds, okay? Sometimes you'll see when we do about financing, you'll also see that they paid out dividends, and then sometimes they'll buy their stock back. I made a post about that last week about a company that was buying its stock back. But a lot of times what companies will do is they will start to buy their own stock back because they know what they're coming out with, they know what their projections are, and they want more control, or they want, because they have the inside view of what they're doing in their company, they're like, you know what? Our company is about to blow up. We're about to do something very, very big. We're about to roll something out. Let's go and buy our stock back from the market. So if Microsoft was selling at 311, Microsoft might have said, you know what? Let's go and buy 1 million of our shares back. So somebody out there selling their Microsoft for 311, Microsoft goes out and buys their own stock back. and then the stock rises to 360, 370. Well, Microsoft just made money on their own stock. Okay, that's called a buyback, and you'll see that in the cash flow statement. All right, that's a good sign too when a company is buying back their own shares. All right, so hopefully you guys got that. Now let's look at what that looks like when we compare that to an individual. So again, cash flow is very similar to an income statement. Cash from operating activities, investing, financing activities. For an individual, this is cash from your income, investments, and even if you borrow money. Outflows. This is cash used for operating activities, investing activities, and financing. And then, of course, on the individual side, cash used for living expenses, investments, and debt repayment. And so, again, cash flow and income statement sound very, very similar. The only difference with cash flow is you got to have that money, you got to balance that money so that each and every month you're paying all of your bills on time. Everything is going out on time. You got enough money to cover all of your expenses, including any emergencies that actually come up. You know, we always talk about having an emergency fund as an individual. Well, companies have to have an emergency fund too. So a company is no more different than an individual. A company borrows money just like you and I borrow money. When we borrow money, it's called a loan. When a company borrows money, it's called a bond. But it's the same deal. Okay? All right. So I'm going to talk to you about a few things that we're going to look at, and then we're going to go look at some stocks. So analyzing a company. The first thing I want to do is I want to look at their sales revenue, and I want to see the top line revenue growth. Matter of fact, before I do that, let's go, and I'm going to do that in conjunction with looking at a stock. So we're going to go over here to a company called MarketWatch. You can do this with Yahoo Finance and many other companies out there, and I'm going to show you Yahoo Finance as well. But what we're going to do here with MarketWatch is we're going to take a look at Microsoft, because I want you guys to understand why I go crazy about Microsoft all the time and why I talk about Microsoft all the time. So let's go here. I'm just going to do a search on the symbol, keyword symbol, MSFT. That's Microsoft. We'll see Microsoft over here. We'll click on Microsoft. Microsoft is trading at 367 right now. All right. And what you're going to see down here is you're just going to see a quick overview. It was going to show you the day range and the 52-week range. And so you'll see that Microsoft at 369, the range, the 52-week range is 370. So Microsoft is trading close to its all-time high. And that's why I don't recommend buying Microsoft today, because it's trading at its all-time high. All right. And so we'll see the market cap, right? We know that this is a mega stock. You should have learned that in week number 1, $2.75 trillion. That's the market cap, right? And so if we take $367 and multiply it times the 7.43 billion shares that are out there, we're going to probably come close to this $2.75 trillion number. All right. But that's not what we're really looking for. This is good information here, but that's not what we're really looking for. What we're looking for is this little link right here that says financials. Let me zoom in so everybody can see that. And maybe I zoomed in too much. Okay. I think you should be able to see that. All right. Scroll down here. We're going to click on financials. Now, once we click on financials, we got to scroll down here just a little bit. Here's what we're going to see. We're going to see those 3 statements that I talked about. We're going to see the income statement, we're going to see the balance sheet, and we're going to see the cash flow. Everybody remember that? Income statement, the balance sheet, and the cash flow. All right. So here's what I'm looking for. When I look at I don't know how to keep this pop-up from popping up. I don't want it to pop up. But when I look at the income statement, what I'm looking at is I'm looking at the sales revenue growth. Okay. That's what I'm interested in. I'm interested in the revenue growth of the company. All right. And what I'm interested in is I'm interested to see the revenue every year make more money than the last. So if we look at sales and revenue for Microsoft in 2019, they made $125 billion. A year later, they made $143 billion. A year after that, they made $168 billion. Now, I want you to compare this to an individual. Ladies, if you got a man, in his first year, he made $100,000. The second year, he made $125,000. The third year on the job, he made $150,000. Does he have your attention? Right? You're like, he's a good prospect. That man's a good prospect because every year he's making more money than the last. Okay? That's what we call top line revenue growth. Top line revenue growth. Now let's go look at the same thing. If I go over here to Yahoo, I'm going to go to Yahoo Finance. I'm going to show you the exact same thing, how we do it in Yahoo Finance. So I'm just going to go up here. I'm going to type in the ticker symbol, Microsoft. In Yahoo Finance, you're going to see there's a section here that says financials. We're going to click on financials. Once we click on financials, we're going to see that income statement. All right. And theirs works a little bit on the reverse. Okay. Total revenue, 2020, $143 billion. 21, $168 billion. 22, $198 billion. And here in 2023, we ain't even over with yet, but they're already $211 billion. So see, the top line revenue growth is growing every year. They're making more money than they made the year before. Now, I need you to write that down. That's a key indicator. If a company makes more money every year than they did the year before, the stock is going to, provided the bottom line is good too. All right, everybody see that? Now, do they put all that money in their pocket? No. You can see there's the cost of revenue. There's operating expenses. There's operating income. We already talked about that, right? We already talked about all of that. But this is our top line revenue. So let me go back to my presentation here. You are looking for increasing growth year over year for the last 3 to 4 years. That's what you're looking for. I want to see a company making more money every year, like Microsoft. That's the top line. Now, let's look at the bottom line, which is my net income. So let's go back over to Market Watch because I'm showing you from 2 different angles here. We're going to come all the way down here. I'm not even looking at all this other stuff. I mean, you can, but there's no need. Here's what you need to know. I'm going all the way down here to the bottom, and I'm looking at net income. They made $39 billion. Then they made $44 billion. Then they made $61 billion. So here's what that means. $61 billion. If I go back to the top, they made $168 billion in sales, but they kept $61 billion. Okay, after all expenses and all that other stuff, they kept $61 billion. And we can see that year over year, the bottom line is growing. So we can see here, I like Market Watch because it tells me about what percentage. They grew by 12% this year, and they grew another 38% bottom line revenue. So what am I looking for? I'm looking for year-to-year growth on bottom line revenue as well. However, it doesn't have to always be, growth like that. But I definitely want to see it if it is. Here's what I don't want. I don't want a loss. Okay. So let's go back over to Yahoo and let's scroll down and look at the net. It's the same thing as what I saw on Market Watch, but I want to just show you what it looks like, how it looks different here. And so what we are looking for is, where is it? Operating income, net income. I believe this is it, right? Let me see. Is that it? No, this is it right here. Net income. Yeah, that's what we're looking for. We're looking for our net income. Okay. And we just want to make sure that we're making money. And you can see 44, 61, 72, 72, 77. So you can see that it's growing. The net income is growing. All right. Now, that's great, June, but show me a company that you might not buy. So I'm going to come over here. I love this company. I love using their services. When I traveled, I use their services all the time. That company is called Uber. Many of you have heard of Uber. UBER. We'll come over here to Yahoo Finance, do Uber over here. I just want to let you know that you can do it in multiple places. Okay. So right now, Uber is trading for $52.15. And some people say, ooh, I can buy some Uber. Man, that Microsoft too expensive. And I want to tell you is that you always buy quality. You always buy quality. I don't care if you don't have $300. If all you got is $52, then buy $52 worth of Microsoft. I'm about to show you why. Okay. Now, we're going to look at Uber, which is a growth company. And I'm not saying that Uber is a bad company to invest in, but based on what I like, and I like to stack the odds in my favor, I'm not going to invest in Uber, and I'm going to show you why. So we're going to come down here. We're going to look at the financials. Click on the financials. We're going to scroll down. We're going to look at our top revenue growth. In 2018, 11 billion. In 2019, 13 billion. In 2020, 11 billion. Okay. So we can see that it started off pretty decent, but in 2020, it didn't. Now, that's okay. I'm okay with 2020. Do you guys know what happened in 2020? Because see, when you start looking at the numbers, and if the numbers are not jiving right, you got to say, well, what happened in 2020? Somebody tell me what happened in 2020. That's right. Bridget said the pandemic. So that meant that people were staying at home. That meant that people were not taking Ubers. So the fact that they had a down year doesn't disturb me as much, because in 2020, wasn't nobody in Uber cars. They weren't riding Uber. So see, every company has a story. You have to understand that just because this number is a little lower, you have to then ask yourself why. Because if it makes sense why, then this still might be a good company to invest in. Let's go over to Yahoo and look at Yahoo, because this doesn't show me as much of the years. So I'm going to go over here to Yahoo and look at Uber Technologies on Yahoo. We're going to click on financials. And we're going to look from 2019. So 2019, 14 billion. In 2020, 11 billion. And then they got back on the ball. Remember, we know what happened in 2020. Then they went to 17. Now they're at 31. And the trailing 12 months, that's what TTM means, the trailing 12 months. So we're in the month of November. So this number is from November to November is 35 billion. Okay. And you may say, well, June, that's million. Nope. All numbers here are in the thousands. Okay. So this is going to be billion. Okay. Now, this looks like a good company, doesn't it? because top line revenue growth is growing with the exception of 2020, but we know what the reason why. So I'm okay with that. I'm okay that it did not grow in 2020 because I know the reason why. But as I look at the rest of the years, they're making a killing, right? They're making a killing, top line revenue growth. But here's what we want to do. We want to look at that bottom line revenue growth. So let's go take a look at the bottom line revenue growth. We'll scroll down here. Let's look at the net income. Look at here. Negative 8.5 billion, negative 6.7 billion. And I bet if I could scroll over, let me see if I can scroll over. Boom. So negative 9 billion, negative 496 million. So what you're seeing is, I'm gonna go back to the top. You're seeing top line revenue growing, right? $31 billion. But if I come down here to the net income, they're negative 9. So here's what that means. If they're negative 9 billion and they made 31 billion, that meant that they made 31 billion, but they spent 40 billion. Go back. If it's 31 billion here that they made, and when everything flushed out, they were negative 9 billion, that meant that they spent $40 billion. They spent more money than they took in. That's a red flag to me, right? Now, there's a reason why Uber is doing this, okay? Let's go look at Yahoo Finance so you can see the same numbers. If I scroll down and I start looking at their net income, what did I say? They were negative 9. Let's come down here and see where's the net. Where is it? Where is it? Where is it? Where is it? This is it right here. Negative 9. Yeah. Okay. So we see that they're spending more money than they're making. Okay. Now, again, if you got a job and you make $100,000 a year, but you're spending $150,000 a year, how long are you going to be able to do that? To see, when we're looking at these companies, we have to evaluate them just like you would evaluate an individual. How long can you continue to spend more money than you make before you wake up one day and you're in trouble? So I just shared with you just 2 indicators, but these are the top indicators that make a whole lot of difference here. I want to see top line revenue growth. Uber has fantastic top line revenue growth. They got fantastic top line revenue growth. If you just look at top line revenue growth by itself, you're gonna be caught short because you got to go look at how much money are they spending. It don't matter how much you make, it's how much you keep. So they're making more money every year, but they're also spending more money every year. Now, why do people say that Uber's a good buy? Because you're going to have people that say Uber's a good buy. Because Uber is a growth company. We covered this last week when we looked at the categories. Uber is a growth company. They're taking all of their profits and reinvesting all of their profits back into their company. So they're at the stage of growing. And when you have a growth company, oftentimes a growth company is going to spend more money than they make. So could Uber be a great company one day where you're going to make a lot of money? Yeah. If I was in my 20s, I might buy 100 shares of Uber. But right now, I'm not buying nothing until Uber can tell me that they not spending more than they make. Because I'm 52. I ain't got time to play around with Uber. I don't know. Now, if I'm young, I'm willing to take that risk. So this is why I want you guys to understand the risk reward portion. I'm not saying that Uber's a bad company. I'm just saying that for a 50-year-old who's near retirement, this is probably not the company that you want to be taking some risk on. But if you're in your 20s, maybe your 30s, and you got some money that you can, risk, and you can see Uber pulling this thing off and becoming the next Microsoft or the next Apple or the next whatever, then cool. But if you at my age, I'm not playing with this. I ain't playing with my money. I like my money. I don't like losing. I hope everybody understand my thought process here. All right, let me check the chat real quick and see. Can you tell what they're spending their money on? Okay, great question. So the answer to that is you can tell what they're spending their money on. So when we get down here to the net, this is our net. Their money got spent on all of this stuff here on the left-hand side. This is what they spent their money on. Okay. So yeah, you can see what they spent their money on. I can open all of this up and tell you where they spent their money, but I don't care. All I care about, because see, I'm not trying to make this complicated for y'all. I'm not trying to make you a statistician. All you need to know is what is the top line revenue, what's the bottom line revenue. And if they are spending more money than they're making, I might not want to do this. I ain't trying to make you a statistician and talking about, well, they paid this in taxes and they did. I ain't trying to do that because I don't do that. I don't care. I don't care what their excuse is. If the guy that you dating or the woman that you dating, if she made $100,000 but she's spending $120,000 a year, do you care why? I don't care. We ain't dating no more. You're not the one. You ain't the one, baby. All right. So hopefully y'all get that, right? It don't matter what they're spending their money on. But I get what you're saying. But it's yes. So yes, you do know what they're spending their money on. You just have to. I just don't care what they're spending their money on. Okay. But now, don't get me wrong. Can Uber one day be a great company? Yes. Do I love Uber? I ride Uber all the time. I have people deliver food for me from Uber all the time. I utilize their services, but I'm not buying their stock until I got my eye on them. And every now and then I come over here and I look at what that net income is. Right now, it's still negative. Now, here's something that you can also check out and see. So as you can see, the years are going from low to current, okay, from low to current. Now, if I come down here and I look at net income, and let's say that they were 8.5, then they're 6.7, then they're 496. So they're headed in the right direction. Does everybody see that? Even though they're still negative, with the exception of this year, of that particular year, they're headed in the right direction. They're getting closer and closer to not spending more money than they make. So again, if I'm young, I'm 20, I'm 30 years old, I'm investing in Uber. Yes, I'm investing in Uber if I'm 20, 30 years old right now, because I see that they're getting better at managing their money, and they're getting better to a point where they're going to start making some money at some point. Does everybody see that? 8.5, then 6.7. That meant that they didn't spend as much money. They didn't go overboard, and it's getting lower and lower. With the except, I don't know what happened here. So now I got to go and find out what happened here. Here's the other thing. When you start looking at these numbers, they're going to give you clues to make you go dig even further to say, okay, what happened? You were headed in the right direction, and then this year you went crazy. What happened? And then you got back on track. I want to know what happened that year. Okay, so then I'm going to do some research and I'm going to find out, okay, what happened that year that they spent all of that money. Okay, does that make sense? I hope that makes sense. Okay. All right, let's check my chat here real quick. Yeah, I'm not, yeah. How are they still in business if they're doing so far in the negative? Is it tax benefits that's helping them? Um, there's a lot that it is. There's investors, people still buying the stock, right? Um, you're taking out loans, you're getting loans. There's all of those things that come into play. So yes, they can spend more money than they got coming in. It's just like you can spend more money than you got coming in. You got $100,000 a year salary job, but you spend $120,000. How did you do that? Loans. You borrow money. So yeah, you can do that for a while. You can do that for a while. Remember, Amazon didn't make money for years. I think it was 7 or 8 years that Amazon took a loss. So yeah, you can do that. You and I can do that. Most people do that. Most people that you look at that live in this world today, most people are spending more money than they make. How do they do that? Debt. Debt allows you to spend more money than you make. Okay. All right. So that's Uber. All right. So we looked at the fundamental analysis. We looked at the top line revenue, and we looked at bottom line revenue. Those are my two critical things. If these two things don't look the way I want them to look, I don't even go any further. Okay. Now let's talk about the next thing. What else am I looking for? I'm looking to see how much cash they have on hand. How much cash do they have on hand to, one, survive a downturn, or two, pay off any short-term debt? Now, let me explain what I mean by that. Many of us look at companies, and these companies look like they're great companies on the surface. But when the tide goes out, we get a chance to see what you're working with. You big John Holmes, you tell me that you John Holmes, but when the tide goes out, we get a chance to see what you're working with, right? So let me give you an example. How many companies filed bankruptcy in the pandemic that you were just surprised? You were surprised that these companies filed bankruptcy in the pandemic. That's because when the pandemic happened and people no longer was going to the stores, or there's no longer shopping, the way that they normally shop, if you didn't have cash on hand to survive, you went out of business. And there was plenty of them that went out of business. So let me show you what I'm talking about. So we're going to go back here to Market Watch. I'm going to go back over here to Microsoft. We'll go and search on Microsoft again. Let's do our search on Microsoft. And now, under financials, here's what we're going to take a look at. Now, under financials, we are going to take a look at their balance sheet. Let's take a look at the balance sheet. Okay, we'll look at the balance sheet. So on the balance sheet, here's what I see. In 2019, Microsoft had $133 billion in cash and short-term investments. In 2020, they had $136 billion. In 2021, $130 billion, and in 2022, $104 billion. And now in 2023, $111 billion in cash. Now, it doesn't matter to me if this is trending, going higher and higher. I don't care about that. I care about that with sales and net bottom line, but on cash, I just want to see how much cash they got. So in 2023, they got $111 billion in cash. Pretty well, you can see in cash, they got $34 billion. The rest of it is going to be short-term investments. But let's just say they got $111 billion that they can access as cash. Okay. Now what I want to do is I want to scroll down, because that's under the asset column. You see the assets. This is on the asset column. I now want to go down to the liability column. So let me look at this again. $111 billion. 34 billion of that is cash. So we're going to come down here and look at the liabilities. Now, short-term debt under the liabilities. Short-term debt is $10 billion. Matter of fact, this is short-term debt and a current portion of long-term debt. So short-term debt, this is debt that needs to be paid within a year. $1.9 billion of debt. The total with long-term is 10.8 billion. So now let me go back up to the top again. $10.8 billion of debt. In cash, we got over $34 billion just in cash. That ain't including our investments. So the question is, can they pay their debt? If they wanted to stroke a check tonight and pay the whole debt off, they could. I'm cool with that. As long as you got the money and you can stroke a check and pay off all your debt with one check, I'm cool. So that's what I'm looking at. I'm looking at their debt. Okay? Everybody understand that. So it doesn't matter to me if you're an individual and you got, June, I got $100,000 worth of debt. Okay. But I got $500,000 sitting in my checking account. All right, cool. You ain't in trouble. You got $500,000 of cash sitting in your checking account, and you got $100,000 worth of debt. Okay, cool. Young lady, she got $500,000 of cash in her checking account and $100,000 of debt. I can work with her. Me and her we can still date. We dating now. We dating. It's when it's the reverse. You got $500,000 worth of debt and $100,000 in your checking account. We got a problem. Okay. So as an investor, this is what I'm looking at when I look at the balance sheet. I'm looking at what they got cash. I'm looking at what they got in debt and liabilities. And I'm asking myself, can they pay off their liabilities with their cash? And if they can, then I ain't tripping on that, right? I'm not tripping on that, all right? So you'll see all of that, right? And maybe you even want to go down here and look at their total liabilities, right? You can look at their total liabilities. But I'm not tripping on their short-term, long-term debt. Now, here's what you have to be careful of is when we go and start looking at the debt here, you want to be careful to make sure that their short-term debt, which is here, is not larger than their long-term debt. Because short-term debt, that's debt that's got to be paid within the year. And so I don't want to be in a situation where I got a company that can't pay their debts, or if I see that their short-term debt is creeping up, like here, Microsoft's short-term debt is creeping up. But here's what I also know. If I go and I look at what did they buy and what all of that, here's what I'm going to see. They just bought ChatGPT. I won't say bought, but they invested heavily in ChatGPT. So I understand where some of this money is going. Now, next week, I'm going to show you how to find out even more details, because I sit on the calls, the earnings call, when they make their earnings announcement. Okay. But this is just going to tell me, do I even want to mess with Microsoft? And the answer is yes. Yeah, we can play. Me and Microsoft can get along. I can get along with Microsoft. Let's take a look at Uber. Do the same thing with Uber and see what Uber's numbers look like. And I ain't picking on Uber, but I want to show you an example of a company that is a growth company, and you can't look at it the same way that you would look at another company like Microsoft. So we're going to take a look at the financials. We're going to take a look at the balance sheet. And the cash that they have on hand. Okay. So let's come all the way over here to 2022. They got $4.9 billion of cash. All right. Now, check this out. They got $4.99 billion of cash, and most of it is cash. You see that? That's something else. So with Microsoft, they had more short-term investments than they had in cash. You know why? Because they had so much cash. It's like this is a good example. If I look at your personal finances and I see that you can put $500,000 in your savings account, I'm gonna be like, what you doing? Like, keep 100 in your savings account, take the other 400 and put it in a CD that's paying 5%, put it in something that's going to actually give you a return on your investment. What we see here is Uber got most of their money in cash. They ain't even got money to really even do short-term investing. Does everybody see what I see? Right? There's a very big difference between what they have done and what Microsoft is doing. All their money is sitting in cash, right? Cash and short-term investments, pretty much all their money is sitting in cash. Now, let's go and take a look at their liability. So we come down here. So what did we say? We said 4.9 billion. Okay. Let's come down here and take a look at their liability. All right. Short-term debt, 103 billion. Okay. I can deal with that, right? So not so bad. The only thing I don't like about them right now is they spending more money than they're bringing in. But when I look at the debt, doesn't look like, am I looking at this right? Oh, wait. Let me scroll. My bad. Okay. My bad. So they got 495 million in short-term debt, long-term debt, right? So short-term debt, 353 million. If we go back up and look at how much money they got in cash, they got 4.9 billion in cash. So they straight on the balance sheet. They're straight on the balance sheet. Okay. I'm okay with that. All right. Everybody see that? That's important, right? That's important so that you begin to know what this is all about. Okay. All right. So go back here. I want to take a look at how much cash is on hand. Can they survive a downturn? Can they pay off short-term debt? That's what I'm looking at. Okay. That's what I'm looking at. Right. Debt liabilities. We just looked at that. I want to see how much debt the company is carrying. Is the short-term debt larger than the long-term debt? I want to see when they get in trouble. And I want you to think about an individual. If an individual gets in trouble, I got a friend of mine, he lost his job last year. He just got a job last week. Praise the Lord. But I said, man, how you been, surviving, what you been doing? And he said, man, I've been living off of credit cards and a prayer. So what has happened is he lost his job. He ran through his emergency money. Then he started running through credit card debt. So if you were watching him and looking at his financials, you will start to realize that his short-term debt started getting larger and larger and larger. Because credit cards is short-term debt. Long-term debt on a person would be a mortgage, maybe even a car loan, but credit card debt would be short-term debt. So you can see that when the short-term debt starts going higher and higher and higher and higher, that person is in trouble financially. Plus, he ain't got no income coming in, so his top line revenue is gone. That's danger. So the same thing is true when we start looking at companies. All right. And then the last thing I want to show you is something called free cash flow. So let's go back over. And since we're already here on Uber, what I'm going to do is I'm going to go down here and look at the cash flow. So we look at cash flow. And under cash flow, there's a lot that you can look at here. I mean, you can look at all of this stuff here, right? But for me, I go all the way down here to the bottom, because this is what I'm interested in: free cash flow. And let's talk about free cash flow for a moment. Scroll over here. Right. So here's free cash flow. Okay. So they got $390 million of free cash flow. So I think I'm looking at Uber and I'm saying, you know what? As I'm looking at them, I'm seeing them getting better and better. Their financials are getting better and better. I taught this class last year and it wasn't the same, but I see their financials are getting better and better. So Uber might be something on my list, okay? But the financials are getting better and better. They're not there yet, but I see that they're working on that. So this might be a company where if you're young, and I keep saying if you're young, if you got some time on your hand, that's what I mean when I say if you're young. If you got some time on your hand and you're willing to wait for this stock to maybe flip, then you could be getting in at a ground floor level, right? But $390 million of free cash flow. So somebody says, well, June, what is free cash flow? So let me just kind of tell you what free cash flow is. Free cash flow is the amount of cash that you have left over after you pay all of your operating expenses and capital expenditures. Now, I didn't say after you paid your debt off. All I'm saying is you got paid. The minimum credit card payment was $25. You paid the minimum. You paid your car note. You paid your insurance. You did not get out of debt, but you don't owe nobody for the month. And at the end of the month, you still got $500. That's called free cash flow. And that free cash flow is what allows you to make some decisions. With that free cash flow, I can take this $500, and if I want to go and invest, I can invest. If I want to take some of this $500 and do the snowball on my debt, I can do snowballing on my debt. So I'm looking for companies that have free cash flow because now that gives them options. They've paid all of their expenses. They don't owe anybody. They got good credit, but they got some money left over. They got enough money left over that depending on what they decide they want to do, maybe they want to go and pay down some debt. Well, now you got, in this case, Uber has what, $390 million that they can go towards paying down some debt. And maybe that's what they do. Or maybe they want to take that $390 million and do some expansion. Or maybe they want to take that $390 million and buy some stock in Microsoft. So what that free cash allows you to do is it gives you some flexibility, some room to do some other things. Okay? And I like that. I like that a company has options with their free cash flow. Let's take a look at Microsoft. Look at their free cash flow. Come down, we're going to look at the financials. We're going to come down and we're going to look at the cash flow. And then I'm just going to bypass all this stuff and come down here and look straight at the free cash flow. Okay? Keep going down. Here's their free cash flow. They've been having free cash flow for a long time. Okay? They got some real free cash flow. 45 billion, 56 billion, 65 billion, 59 billion, right? They got some serious free cash flow. That's why I like Microsoft. See, Microsoft is hitting on all cylinders. All cylinders. They got some serious free cash flow. All right? All right. So this is week 1 of financial analysis. And these are just some sites that you can use. I like Yahoo Finance and Market Watch. That's what you saw here today. You saw me using Market Watch and Yahoo Finance. I love those two, but there are plenty of resources out there that you can begin to look at a company's financials and determine if the financials meet what you are looking for. So for me, Microsoft is definitely my player. Uber, I'm still kind of hesitant on Uber because, like I said, I need my stock to make some money. But I could see that Uber is definitely shifting gears, and they're turning their ship around. And I wouldn't even say turning it around because they're a new company, relatively new. Uber is relatively new compared to a Microsoft. So Uber is still a growth company. And remember what we talked about growth companies. And hopefully you understand why each week I cover what I cover, because it builds upon the last. It builds upon the last. All right. All right. So let's take a look here. That's all I got for you here tonight. Let's take a look at some of the questions. I got a Q&A that's here. And here's what it says. It says, with Amazon, we know it's going to make money at Christmas time of the year, and sales goes down in January. Okay, so before we do that, Regina, I gotta correct you. We don't know nothing until it happens. You don't know nothing until it happens. You don't know if Amazon gonna make some money. We don't know that. So we don't guess on that. We think Amazon might make some money because it's Christmas time, but we don't know that for sure. Okay, so I want to correct that. I don't want you to make that mistake to go buy something because you know, but you haven't done the homework. You haven't looked at them. Okay, Amazon's a great company, and I got some Amazon, but I don't want you to make that statement because we don't know that. And sales goes down in January. We pay bills in January where the banks now are making money. So how do we know when to invest in these according to these charts, knowing that this time of the year may be treaty? Okay, so here, let me answer that question for you. Let me paint something for you. We do want to see how sales goes in the next week or two, like Black Friday. Black Friday, we want to see, are people going out and spending money? And there will be some consumer index reports, and I'm going to talk about that next week. There are different reports that will come out that will talk about how well or how positive consumers are about the economy. There are economic reports that will report on how consumers are positive or negative about the economy based on their spending habits. So if consumers are very positive in the next 2 weeks and they go out and blow a lot of money on retail, then that is going to be an indicator that maybe you want to get some retail. But just because they're spending money, you got to figure out where they're spending money at. Are they spending money with Neiman Marcus, or are they spending money at Walmart? Right? So we got to figure that out. The second thing that we have to understand is that if I spend the money now in November, you're not going to see that from a stock perspective. You're not going to see that for at least 3 months. Here's why. They only report their earnings quarterly. So just because I spend a lot of money in November, when's the next time that Amazon is going to have their quarterly report? So let's do that real quick. Let's do that real quick. Let's share our screen because I love what you're saying. I love it. So we're going to go over here to Google, and I'm just going to type in something very basic and simple because I don't want you guys to think you got to be, when is Amazon's next quarterly report or earnings date? That's really what I want to say, but all right. So it is telling me that Amazon is going to report their next earnings announcement on between February 1st and February 5th of 2024. So here's what that means. That means that you may want to get you some Amazon if you hear that everybody's buying and they're shopping and they, Amazon shopping is going up right now in the month of November. You got to put that in the back of your mind, and maybe in January, the end of January, you might say, let me go and pick up some Amazon, because their earnings announcement, their earnings report is coming out. And I remember back in November, they were talking about how well shopping was, and how well Amazon was doing. There'll be numbers out there, but by the time we get to February, most people will have forgotten about what happened in November. So you can use the news to help you determine if this is a good stock to purchase or not. Plus, when we get to technical analysis, I will show you how to look at, and some of you who have been in my class before, I'm going to show you how to look at Bollinger Bands to determine if you want to buy Amazon or not, or when is the best time to buy Amazon or not. Okay. So we don't know yet. We don't know that yet. Okay. So we're guessing, but we don't know that. And I don't want us to guess. I want us to know for sure. But I love what you just said, because Amazon, Walmart, do not buy Target. Target is in financial trouble right now. Target is, there may not be any more Targets. And I'm serious. I'm going to show you Target's stock chart. I'm just going to show you the chart. So here's Target. Target is trading at $107. I'm going to show you the 5-year trend on Target. You can see Target is in a downward. There may not be any Targets in the next couple of years. Okay. If Target don't get it turned around. So Target was July of 2021 was at $261. It's now trading at $107 and it's still trading down. I wouldn't, unless you are selling puts on Target, I probably wouldn't mess around with Target. Okay. So this is an example that we got to do all of our homework. Even though we think that a company is going to do something, we got to do the research. We can't go off a gut feeling. We got to look at the numbers, because numbers don't lie. And that's what fundamental analysis is all about. It's all about looking at the numbers. Our gut can tell us, hey, let me go look at Target. Hey, let me go look at Walmart. Hey, let me go look at this company. The other thing I might want to look at with holiday season coming up is I may want to look at the stock of FedEx, UPS, because they're going to be delivering packages. So I may want to go look at that stock, and I want to go look at those numbers, and I want to go see what happens, because it's easy for everybody to say, oh, everybody's talking about retail is up, or let's go buy some Walmart, or let's go buy Amazon. But a lot of people forget that the FedEx truck, the UPS truck, they're delivering packages as well throughout the holiday season. And so you got to look at all of the different companies that's going to be impacted by this holiday season. And depending on what people do on Black Friday will determine whether or not you should probably be looking at an Amazon or a Target or something of that nature come their next earnings announcement. But I wouldn't buy, like, if Amazon had the great reports come out about Amazon or about shopping, I probably wouldn't be necessarily buying Amazon just off of that. I'm going to look at the Bollinger Band and see where they are. I'm going to keep that in my hat. That's a feather in the hat. But I'm going to wait until they get down below that Bollinger Band before I actually purchase. If you have no idea what a Bollinger Band is, keep coming to my class. We'll talk about it. All right. Great question. Great question. Okay. All right. Let's see what else we got here. Benita says FedEx. No. What's wrong with FedEx, Benita? Tell me what's wrong with FedEx. What is your Facebook page? Investing for beginners. All right. Let's take a look at the Q&A here real quick. See what we got in Q&A. Oh, okay. I think I just answered that question, Regina. So hopefully, Regina, I just made sense on your question. That is important. Okay. Let's take a look at FedEx. All right. Let's take a look at, I'm going to look at the trend on FedEx. Let's take a look at Max. Okay. 5 year. All right. Let's take a look at the financials. $69 billion, 83, 93. They're a little short, but we still got some. Well, they're a little short. They fell off about 3 there, but top line revenue doesn't look too bad. Let's go take a look at bottom line revenue. Bottom line revenue doesn't look too bad. Okay. Go take a look at the balance sheet. We're looking at the total assets. This is going to be their cash. Okay. Let's take a look at their liabilities. Current debt. Debt doesn't look too bad. Debt looks awesome. Let's take a look at their cash flow. I'm looking at their free cash flow. Look like good free cash flow. So what's wrong with FedEx? Okay. So here's what I need you guys to understand. So Benita, I said FedEx, you said no. You said their rates have gone down. Their rates. So when you are determining whether you should invest in a company or not, you got to look at what we just looked at. You can't look on the surface. You got to look at their numbers. A lot of people don't invest in companies because I hate Delta. I would never fly Delta. I'm gonna fly American Airlines or anybody else but Delta. You got to go look at the numbers. I'm here to make money. I want to invest in a company to make money. I'm not in love with any company. If Microsoft did not make me money, I would drop them in a heartbeat. I drop them like a hot potato. I am not in love with any of these companies. What you've got to do, whether you hate them, love them, I don't hate, I don't love. What I'm looking for is I'm looking at the numbers because the numbers don't lie. It don't matter what your emotions tell you, how you feel. It doesn't matter if you think that, oh, because it's Christmas time and people spending money, I'm going to go over here and buy some Walmart stock. No, that is the wrong way to invest. The right way to invest is how I'm teaching you guys. You have to look at the fundamentals. If you take your emotions and you say, I went down to Walmart on Black Friday and I got ran over by the crowd. I think I'm gonna go buy me some Walmart. If that was your indicator of buying stock, you are going to go broke. The reason why we're in this class here is so that you can learn the proper way to look at a stock and determine if you should get the stock or not. Now, I don't see anything, there's nothing that stands out alarming to me about FedEx. I would still do some technical analysis on it, but I think it's okay. I'm gonna look at UPS and I would compare the two. And I'm gonna buy the best of the best. So if UPS looks better than FedEx, I'm gonna buy some UPS instead of FedEx. If Walmart looks better than Target, I'm gonna buy Walmart. If Costco looks better than Walmart, I might buy some Costco. So a lot of times we would compare the competitors, and usually they're gonna have the competitors right here on the right hand side. So boom, there's UPS. So I would just go straight over to UPS and see what UPS numbers look like in comparison to FedEx. I ain't in love with none of these. I just want to get the best company based on what the fundamentals say. And that's why I love fundamentals, because fundamentals don't lie. Numbers don't lie. If you learn how to pick your stocks based on numbers, based on what the numbers are telling you, you're going to be fine, right? You're going to be fine. Victoria says trading in the zone talks about our emotions when investing in the stock market. Absolutely. Absolutely. You cannot be emotional in the stock market at all. You cannot have any emotions. It is what it is. Let me go look at the numbers. What do the numbers tell me? If the numbers tell me that FedEx is a good company for me to invest in and I'm going to make some money, I'm going to go invest in FedEx. If the numbers tell me that UPS is a better company, I'm going to invest in UPS. All right? Everybody got that? Hopefully everybody got that. That's important. That's important because we can't get in our feelings when it comes to investing. And I know a lot of people do that. You hear people tell you, I'm going to stop sharing here so I can come on screen here. You're going to hear people tell you this advice, and there's nothing wrong with this advice, but it comes with a caveat. They're going to say, well, invest in what you like. Invest in what you like. Invest in the products and services of the companies that you use every day. At one point, when I was traveling all over the country, I was using Uber every week. That's not good advice for me to invest in what I use and what I like. Just because I use Uber and I like Uber doesn't mean that I need to go over there and put my money in Uber. I need to go look at the numbers first. Now, if I stay at the Marriott, maybe I go and do some homework and look at the Marriott and then determine if I want to invest in the Marriott. But I'm not going to invest in the Marriott just because the last time I stayed at the hotel, they gave me some hot cookies and they brought me, you know, a warm, heated robe and all that stuff. I'm not going to, because that's emotions. That's not numbers. Okay. All right. Any other questions? Now is the time for us to open up for questions. And while we're waiting for the questions to come in, I'm going to drop in the chat. I am going to drop the link to where all of this information can be found every week. If you click on that link, make sure you save that link. It's in the chat. All of tonight's recording will be there in the next 24 hours. The presentation for tonight is already over there in the week 3 folder. We will have the testing will be over there sometime this week. We'll have it over there sometime this week, so you'll be able to go over there and get access to that. Okay. Terry says the Facebook link. Terry, here's what I'm going to do. Hopefully you and I are connected on Facebook and I can invite you. You can't get there with just a link. Let me see. Terry. All right. So Terry, you and I do not appear to be friends on Facebook. Let's go ahead and change that, and then I can add you to the group. Terry Greco. All right. Oh, there you are. Yeah, we are friends. Okay. Boom, boom. I just sent the invite to you, Terry, so you should have the Facebook invite. Good stuff. Okay. Anybody else? Anybody else? Let's see. the test did not work for week 2. Let's go and take a look at that. Oh, and I didn't go over the answers for the test for week 2 either. So let's go take a look at that real quick. So all right, so this is the folder. Inside of the folder, we got week number 2. We got the week 2 quiz right here inside of the folder. Let's click on that. And there is the quiz. So I'm not sure why it didn't work for you, but try that again. We got 19 people that have taken the quiz. So try that again. Let's go over the quiz real quick. Which of the following is a type of stock that is considered to be a blue chip stock? So the answer to that is a stock of a well-established company with a strong track record of profitability and dividend payments. That is a blue chip stock. Number 2, which of the following type of stock is considered to be an income stock? That's going to be a stock of a company that pays high dividends, okay? So dividends is going to be income. Which of the following is a type of stock is considered to be a value stock? That is going to be a stock of a company that's trading below its intrinsic value. It's trading below the intrinsic value. That lets you know that this is a value stock. So if the value of the stock is $100 and it's trading at 80, that means it's trading below its intrinsic value. That makes it a value stock. Which of the following is a type of stock that's considered to be a growth stock? Growth stock would be a stock like what we looked at tonight, Uber. A stock that reinvests its profits and is expected to experience rapid earnings growth. That would be your growth stock. Okay, so Uber doesn't pay out dividends, it's reinvesting its money, so that would be a growth stock. Which of the following type of stock is considered to be a speculative stock? This is going to be a stock that is highly volatile and risky. That is a speculative stock. Which of the following is a type of stock that's considered a cyclical stock? This is a stock that is highly sensitive to the changes in the overall economy. So when the economy is good, certain cyclical stocks do really well. When the economy is bad, they don't do so good. But then when the economy is bad, there's other stocks that do well in a bad economy. Those would be considered cyclical stocks. They're based on the cycle of the economy. Which of the following type of stock is considered to be a defensive stock? This is a stock of a company that's expected to experience steady earnings growth regardless of the economy or the economical, I think that's what I said, regardless of the economic cycle, okay? So this is gonna be your Hormel Foods, your gas stations, your grocery stores. It doesn't matter if the economy is up or down, we're still gonna eat, we're still gonna heat our homes, we're still gonna spend money with those companies regardless of what happens in the economy. That is considered a defensive stock. True or false? Blue chip stocks are typically more volatile than speculative stocks. That is false. A blue chip stock is more stable than speculative stocks. True or false? Blue chip stocks are typically more risky than growth stocks. That is false as well. Microsoft is a blue chip stock. Uber is a growth stock. Uber is more riskier than Microsoft at this point. And then the last one, true or false, income stocks are typically expected to experience slower earnings growth than growth stocks. That is true because income stocks are not necessarily reinvesting their profits. They're paying out their profits in the form of dividends. Okay, so a company like Coca-Cola would be a great income stock. AT&T, a great income stock. They are not going to be doing what Microsoft is doing right now. They're not going to go from 311 to 369 in 6 weeks, because they are basically income stocks that's paying out good dividends, and that's what they do. Okay, so there we go. There are the answers to the test, and you should be good. Okay. All right, get to bed, Mr. Simpkins. We're done with the class tonight anyway. All right, see you online next week, Mr. Simpkins. All right, but ladies and gentlemen, I think we have covered everything that I want to cover tonight. Make sure that you get that link that I dropped in the chat so that you can go and get tonight's presentation and go back and review it. This is week 1 of fundamentals. Next week, we're going to continue with fundamentals, and we're going to start talking about ratios, price to earnings ratio, debt to income ratio, debt to equity ratio. We're going to talk about consumer price indicators, all of those types of things that move and make the market move. We'll be talking about those next week. Let's see, any chat? Okay, nothing in the chat. I don't see any questions. I don't see any hands that are raised. So make sure you get that information. I'm going to pop it in the chat one more time so that you don't miss it. Make sure you get that. Make sure you study it, and we'll have a test out for you sometime this week, and we'll get that going. Until next Monday, God bless, take care, and good night, everyone.